What would you do if your company, if you just lost $200 million in basically 90 days?
Oh, I mean, panic, absolute panic.
Right. You would panic. The board would be calling an emergency meeting. Heads would roll, the whole 9 yards.
Yeah, that is a massive crater.
But when Galaxy Digital reported exactly that kind of devastating paper loss last quarter, the CEO, he literally got on the microphone and said to his investors with a completely straight face, I feel pretty good about the business right now.
Which is, just wild to hear.
It really is. So Welcome to this deep dive. Today, we are going to figure out how a $200 million crater in a balance sheet is actually hiding one of the most aggressive billion-dollar corporate pivots happening in the world right now.
Yeah, because it is the ultimate cognitive dissonance, right? For anyone just casually skimming a standard financial headline.
Exactly.
You see the massive negative number, and well, your brain immediately categorizes the company as a failing enterprise.
It's so true. And we have a really fascinating stack of source material to get through today. We are unpacking the Q1 2026 earnings call of Galaxy Digital, which trades under the ticker GLXY.
Yeah, GLXY.
And for you, the listener, whether you are managing a personal portfolio or prepping for a corporate strategy meeting or just fiercely curious about where the global economy is heading, well, this is a masterclass in reading between the lines.
It really is.
We are going to look at the raw data, the executive commentary, and the hidden mechanics of what they're actually building.
And to ground this conversation, we kind of have to understand what Galaxy Digital actually does, because it is not just one thing.
Right. They have their hands in a lot of pots.
Exactly. They operate in a few distinct but, increasingly overlapping arenas. They have a digital assets business, so trading, lending, structuring products in the crypto space.
Okay, the classic crypto stuff.
Right. But they also have a massive asset management arm. And crucially, and this is what we are going to explore in detail, they have an enormous physical data center infrastructure business.
Right. And so the mission for our deep dive today is to really help you see past those highly volatile, flashing red crypto casino headlines.
Yeah, the stuff that just grabs the clicks.
Exactly. We're going to cut through that noise. Because when you analyze the transcript of this Q1 call, you realize that Galaxy is they're quietly building the underlying physical and digital plumbing for two of the most massive global shifts happening right now.
The artificial intelligence revolution and the institutional tokenization of Wall Street.
Yes, the physical and digital plumbing. So while the financial press focuses on the spot price of Bitcoin or, the unrealized paper losses of Galaxy's balance sheet, the operational reality of this firm is undergoing a profound mutation.
It really is a mutation. That is a great word for it.
Thanks. So let's just address the elephant in the room right away. We have to look at the headline shock versus the hidden resilience.
Okay, let's look at the numbers.
We are looking at the numbers for Q1 2026. The company reports a GAAP net loss of $216 million.
Which is about 49 cents per share.
Right, 49 cents per share. Furthermore, their adjusted EBITDA is negative $188 million.
Ouch.
Yeah, ouch is right. And to put that into context, the broader crypto market was just brutal in this quarter. Average crypto asset prices dropped 25%.
Right, a massive hit.
And the total market cap of the entire crypto space declined by a massive 20%.
Yeah, it was a very severe cold snap in the market. And, when the underlying asset class that your company is famously associated with drops by a quarter of its value, well, the immediate assumption from the street is that your operating business must be just hemorrhaging cash.
Totally. But here's the mystery. Despite that 25% drop in global crypto prices, Galaxy's digital asset operating business delivered $49 million in adjusted gross profit.
Which is incredible.
Right. And that number was flat quarter over quarter. Flat. While the market crashed around them, their actual operating engine didn't miss a single beat.
Yeah, it is really something.
And furthermore, their operating expenses actually dropped 7%, down to $147 million.
And this specific dynamic is, it is the absolute crux of the CEO's optimism on the call. It provides a really vital lesson in the difference between corporate accounting and actual cash flowing operations.
Okay, unpack that a bit.
Well, the distinction here lies entirely in the mechanics of unrealized mark-to-market losses versus actual operating revenue.
Let's break that down for the listener because, mark-to-market sounds like something an accountant mumbles before handing you a giant tax bill.
It does sound a bit dry, yeah.
Let's say I own a local coffee shop. If the real estate market crashes, the paper value of the building I own might plummet by 30%. On paper, my net worth looks terrible.
Right, your assets took a hit.
But if my daily foot traffic is exactly the same, and I am selling the exact same number of lattes every single morning, my actual cash register is full at the end of the day.
Yes, exactly.
The value of my asset dropped, but my operating revenue is completely untouched.
That analogy holds up perfectly. And let's apply that coffee shop math directly to Galaxy's ledger.
Okay, let's do it.
So those massive losses you see on their headline, that 216 million GAAP loss, well, those were driven almost entirely by those unrealized paper losses on their balance sheet.
Right, the real estate dropping in value, basically.
Exactly. Their treasury and corporate segment reported a $140 million loss in the quarter, largely due to digital asset depreciation.
And just for background, GAAP stands for Generally Accepted Accounting Principles.
Yeah.
Recently, the Financial Accounting Standards Board, or FASB, they actually changed the rules for how companies have to report crypto holdings.
Right, the new fair value rules.
Yeah. It used to be that if you held Bitcoin, you only recorded a loss if it went down, but you couldn't record a gain if it went up until you sold it. It was treated as an intangible asset, like a trademark. But now, it is fair value accounting. You mark it to market.
Which means basically, at the stroke of midnight on the last day of the quarter, the accountants look at the exact spot price of the digital assets Galaxy holds on its own corporate balance sheet.
Right.
And if the price of Bitcoin is down 25% that day, the value of their holdings goes down 25%. And they are legally required to report that as a loss on the income statement.
Even if they haven't sold a single token, like they didn't actually lose any physical cash,
Yeah.
the underlying value of their reserve simply fluctuated.
Yes. It is an unrealized paper loss. Now, it undoubtedly damages the visual health of the balance sheet, but it does not mean the actual engine of the business is broken.
That makes total sense.
And you contrast that paper loss with their operating businesses. This encompasses the fee revenue they generate from clients, the transaction income from their global markets business, and their asset management fees. That segment generated $49 million in adjusted gross profit.
And this is where I actually need to stop you because something doesn't make sense to me.
Oh, what's that?
Well, trading volumes for the broader crypto industry were down over 25% in this quarter. Retail investors were completely fleeing, yet Galaxy's trading volumes held incredibly steady. How do you maintain your trading volume when the rest of the market is actively running for the exits?
Yeah, that is a great question. And it tells us something profound about the changing composition of their client base.
Okay, how so?
They are adding new trading clients at a steady pace, but the mix of those clients has shifted dramatically over the last few years. A rapidly growing share of their trading volume is now coming from traditional asset managers, sovereign wealth funds, and massive hedge funds.
Oh, so they are not relying on the guy trading meme coins on his phone during his lunch break.
Far from it. Institutional money operates on entirely different mechanical principles.
Right, they have a plan.
Exactly. A pension fund or macro hedge fund has specific mandates. They have quarterly rebalancing needs. They are executing complex arbitrage strategies or trading for yield and structure.
They are emotional traders.
Right. They don't panic sell just because a token dropped 20% on a Tuesday. They rebalance their portfolio according to mathematical models. And that institutional inertia provides an incredibly stable baseline of trading volume for Galaxy's prime brokerage desk.
I see. That is fascinating. And beyond just servicing those institutions, Galaxy's management team was incredibly active in managing their own corporate balance sheet during this downturn.
They really were.
The CEO noted that while the balance sheet lost money, it vastly outperformed what it would have lost if they hadn't taken proactive steps. They cut certain risky positions before the worst of the drop. But the part of the transcript that really caught my eye was their discussion about level 2 exposure.
That is a critical piece of the puzzle, for sure. The CEO spent significant time talking about how they strategically shifted their treasury exposure away from what he termed association tokens and into tokens with actual economic models.
He specifically named a protocol called hyperliquid. Let's contrast these two things. What is an association token? And, why is it dangerous for a corporate balance sheet to hold them during a market contraction?
To understand the danger, you kind of have to understand the mechanics of the previous crypto boom cycles.
Okay, take us back.
For years, developers would launch tokens that were purely associative. You buy the token simply to signal that you are part of a community or to feel associated with a specific software ecosystem.
Just a status symbol, kind of?
Basically. But from a strict financial perspective, the token itself does not entitle you to any real cash flows. It gives you no legal governance rights over the protocol's treasury. It has no underlying economic value derived from the network's revenue.
It's like buying a fan club t-shirt for an indie band.
That is a perfect way to look at it.
Right. You are supporting the band, you feel like you are part of the movement, and maybe if the band gets super famous, someone else will buy that vintage t-shirt off you for double the price. But the t-shirt doesn't pay you a dividend. It doesn't give you a percentage of their concert ticket sales. It is purely speculative memorabilia.
Exactly. And the problem with fan club t-shirts is that when a recession hits, or in this case, a crypto winter, well, those speculative items are the very first things people liquidate to raise cash.
Because they don't actually need them.
Right. There is no fundamental economic floor to the price. It drops until someone decides the quote-unquote vibes are cheap enough to buy back in.
Which means there is infinite downside risk.
So what makes Hyperliquid different then? What makes it an economic token?
Protocols like Hyperliquid are designed with actual value accrual mechanisms. Hyperliquid operates as a decentralized perpetual exchange. It has a real product that generates real trading fees from users.
Okay, real utility. Yes. The mechanics of the tokenomics are structured so that participants who hold or stake the token actually share in the economics of the underlying ecosystem.
So it behaves much more like traditional equity. Like if I own a share of Apple, I own a fractional right to the profits Apple generates from selling iPhones. If I hold a token with a real economic model, I have a fractional right to the transaction fees generated by that specific blockchain or application.
In principle, yes. There is actual math you can do to determine its fundamental value based on network revenue rather than just, guessing what the next greater fool will pay for it.
Which makes it way safer.
Absolutely. And the CEO made a very firm prediction on this earnings call. He stated unequivocally that the era of the pure association token is coming to an end.
Really?
Yeah, he believes that within 5 years, the vast majority of tokens that survive will be forced to restructure their mechanics to provide real economic utility, or they will suffer a slow, agonizing death of participation.
And by positioning Galaxy's balance sheet ahead of this structural transition, basically dumping the fan club t-shirts and buying the cash flow engines, they dramatically softened the blow of the Q1 crash.
They absolutely did.
The CEO mentioned that seeing this specific decoupling, where broader crypto prices fall but Galaxy's operational revenue stays flat or grows, if he could see that phenomenon repeat 4 quarters in a row, it would put a big grin on his face.
It is the ultimate validation that their business model is finally maturing beyond mere beta exposure to Bitcoin. In an industry defined by hypervolatility, your ability to manage operating expenses, cutting them by 7% down to $147 million in a rough quarter, well, that matters just as much as your ability to capture upside in a bull market.
Yeah, definitely. And honestly, if we stopped the deep dive right here, it would be a pretty solid story of corporate risk management.
It would.
They survived the storm, they managed the paper losses, and the core engine kept humming. But we are going to pivot now, because if the trading side is just stabilizing and maturing, we have to look at where the massive exponential future growth is supposed to come from.
And this is where it gets really crazy.
Yeah, this is where the narrative shifts so violently that it feels like we're analyzing a completely different industrial conglomerate. We are leaving the digital realm of tokens and ledgers. We are going to the physical realm, specifically the Texas desert.
We need to analyze the Helios campus.
The Helios campus. This segment of the earnings call is what truly separates this deep dive from a standard financial review. For you listening, to understand the sheer scale of this pivot, you have to know the history of this real estate.
Right, it wasn't always AI.
No, Galaxy Digital bought this massive facility in Texas a while back. Up until very recently, this site was known entirely as a Bitcoin mining facility. It was essentially just rows and rows of warehouses filled with ASICs.
Application-specific integrated circuits. Highly specialized, power-hungry computer chips designed to do one single thing.
Which is?
Solve the cryptographic hash functions required to mine new Bitcoin.
Right. But on this Q1 2026 call, management made a stunning announcement. Helios is no longer just a Bitcoin mining facility. It has mutated. It is now a live, operational artificial intelligence data center.
And this is not just a flashy press release about future intentions. The head of data centers literally stated on the call, the lights are on at the Helios campus.
Wow.
Yeah, they have successfully delivered the first operational data hall to their major anchor client, CoreWeave. The power distribution is flowing, the ultra-specialized cooling systems are running, and the fiber optic network connectivity is live.
We really need to pause and appreciate the engineering complexity here. This is not just updating a few servers in a server rack.
No, not at all.
This is a heavy industrial transformation. It is like taking a factory that manufactures cheap plastic toys and retooling it to build precision aerospace rockets.
That is a great comparison. Because, mining Bitcoin requires a tremendous amount of electricity, certainly. But the infrastructure is relatively brute force.
Just plug it in and let it run.
Exactly. You plug the ASICs in, you blow massive amounts of ambient air across them using industrial fans to keep them from melting. And, well, if the power goes out for an hour, it's not a catastrophe. You just miss an hour of mining rewards.
But AI compute is a different beast entirely, right?
Completely different. The GPUs required for advanced artificial intelligence training, like NVIDIA's H100 or the newer Blackwell chips, they are incredibly delicate and run unimaginably hot.
So fans won't cut it.
No, you cannot cool them with just ambient air in the Texas heat. They require complex, closed-loop liquid cooling systems directly attached to the chips.
Liquid cooling, wow.
Furthermore, if the power flickers for even a fraction of a second during a massive multi-month AI training run, the entire computational process can be corrupted. Millions of dollars of compute time ruined instantly.
Oh, wow. I hadn't thought of that.
Yeah, so the infrastructure resilience required for AI is orders of magnitude more complex than crypto mining.
Management explicitly called this physical transformation the single most important de-risking event the company has ever experienced.
I can see why.
They have fundamentally proven to the market that they can take a dusty patch of land, conceptualize a hyperscale data center, engineer it, and bring it online on time and on budget.
And in the world of heavy infrastructure and commercial real estate, a proven track record is your most valuable asset. It is what separates the dreamers with slick pitch decks from the actual operators.
Let's look at the sheer numbers they're throwing around, because the scale is just staggering. They break this deployment down into phases. Phase 1 is 133 megawatts of critical IT capacity.
That is a lot of power.
It is. They expect to deliver substantially all of this capacity by the end of Q2, and this entire first phase is fully leased to CoreWeave.
Okay, the anchor tenant.
Right. And the economics of this lease, this is where I actually need you to translate the Wall Street jargon for me. They mentioned 15-year contracted cash flows with approximately 90% lease level EBITDA margins.
90% margins.
Right, 90% margins on physical real estate. How is that mathematically possible unless they're doing something illegal?
It sounds impossibly lucrative, I know, until you understand the exact mechanical structure of the deal they struck.
Okay, clue me in.
The secret here is that Galaxy is not taking on the technology risk of the AI revolution. They are not buying the GPUs.
Wait, if it's an AI data center, someone has to buy the tens of thousands of NVIDIA chips, right?
Yes, but that someone is CoreWeave, the tenant. AI chips are incredibly expensive, they're supply constrained, and more importantly, they depreciate at a terrifying speed.
Right, Moore's law, basically.
Exactly. An ultra-fast chip today is obsolete in 3 years. Galaxy looked at that dynamic and decided they wanted absolutely no part of that depreciation cycle. Instead, they are providing the underlying durable physical infrastructure. So the dirt, the massive electrical substations, the reinforced concrete buildings, the liquid cooling loops, and the network fiber.
So they are essentially operating a highly specialized, ultra-high-tech landlord model.
It is functionally similar to a triple net lease in commercial real estate, but on steroids.
How does a triple net lease normally work?
Well, in a standard triple net lease, the tenant is responsible for paying the 3 nets: the property taxes, the building insurance, and the maintenance costs, all on top of the base rent.
So the landlord basically just collects the check.
Exactly. It shifts almost all the operational risk away from the landlord.
Yeah.
So here, Galaxy builds the pristine, uninterrupted power environment, CoreWeave wheels in their depreciating supercomputers, and plugs them into the wall.
Ah, I see.
Once the facility is built and the power is actively flowing, the ongoing operating costs for Galaxy are shockingly low compared to the massive rent they are charging for access to that scarce power. That is the mechanical reality of how you achieve a 90% lease level margin.
That is brilliant.
It generates a pure, contracted cash flow stream that is entirely uncorrelated to the wild price swings of digital assets.
And there was a vital clue dropped during the call about Phase 1. CoreWeave is the entity signing the lease, but CoreWeave isn't necessarily the end user utilizing all those chips.
Right, there is another player involved.
Management stated that CoreWeave's end user for these specific GPUs is a multi-trillion-dollar investment-grade public company.
That is an incredibly powerful anchor tenant to have indirectly.
Right. While they declined to name the specific company, though, anyone following the market can easily count on one hand the number of multi-trillion-dollar tech giants right now. Having that ultimate end user provides an enormous layer of credit security to the entire project.
Because if a multi-trillion-dollar hyperscaler is willing to run their most critical, sensitive AI workloads in your building, it instantly validates to the rest of the world that your building is world-class. It's the ultimate seal of approval.
Precisely. And that brings us to the future phases. Phase 1 is 133 megawatts. Phase 2 is 260 megawatts, which is currently under active construction, targeting delivery in the first half of 2027.
Moving fast.
Management noted that site work, concrete pouring, and structural steel are already advancing rapidly. But Phase 3, this is where the numbers stop sounding like a company and start sounding like a nation state.
Phase 3 is the mammoth.
They are talking about 830 megawatts of approved front-of-the-meter power. For context, 1 megawatt can roughly power several hundred homes. 830 megawatts is approaching the power output of a medium-sized nuclear reactor.
It's massive.
Building the infrastructure to handle a gigawatt of electricity requires billions of dollars in capital expenditure. How do you finance something of that magnitude in an economic environment where interest rates are still historically elevated?
This exact question was actually the very first one asked during the Q&A segment of the earnings call.
Oh, really?
Yeah. An analyst from Citi asked about the current strains in the syndicate financing market for these massive infrastructure deals. And the response from Galaxy's management was incredibly revealing about the hidden mechanics of how capital markets are rewiring themselves around the AI boom.
Let's explore that, because normally if you were building a multi-billion-dollar power plant or data center, you go to a syndicate of huge global banks like the JP Morgan, the Bank of Americas, to get a massive project finance loan.
Historically, yes, you would. Prior to about 6 months ago, the market for this kind of heavy infrastructure was heavily reliant on bank syndicates.
And a syndicate is just a group of banks, right?
Right. It is simply a group of banks that pool their capital to fund a single enormous loan. It spreads the risk, so no single bank takes the entire hit if the project fails. But banks operate under strict regulatory capital requirements, like the Basel III framework. They have concentration limits. They are currently looking at their balance sheets, seeing massive exposure to commercial real estate, and deciding they don't want to tie up billions of dollars in 10-year loans for data centers.
So if the traditional banks are pulling back and tightening their lending standards, who is stepping in to write the billion-dollar checks?
Well, management noted that the high-yield bond market has aggressively stepped in to take market share away from the traditional banks.
Wait, high-yield bonds? The financial media usually refers to those as junk bonds.
They do, yeah.
That sounds inherently riskier. If I'm a retail investor listening to this, hearing that a company is funding a nuclear-scale project with junk bonds sounds terrifying.
The term high yield is historically loaded with negative connotations from the 1980s, definitely. But in this specific modern context, it simply represents a much more distributed, flexible pool of institutional capital.
What kind of institutions?
We are talking about massive pension funds, insurance companies, and fixed income asset managers who are desperate for yield and who deeply understand the macroeconomic megatrend of artificial intelligence. And what is fascinating mechanically is that credit spreads on these bonds are actually tightening.
Tightening spreads means the investors perceive the debt as becoming less risky. Right? So they are willing to accept a slightly lower interest rate to hold it.
Exactly.
Why are they feeling so confident about a massive construction project?
Because the credit rating agencies have come through, done the math, and started to rate these debt issuances very favorably. They recognize that these are long-lived, exceptionally durable infrastructure assets.
Even if the AI bubble bursts.
Yes. A world-class AI data center with a gigawatt of power interconnectivity in Texas is a highly repurposable asset. Even in the catastrophic scenario where a specific tenant goes bankrupt, the underlying physical asset itself, the massive electrical substations, the cooling towers, the sheer access to grid power, is so incredibly scarce and intrinsically valuable that another hyperscaler would instantly swoop in and take over the lease.
So the land and the power lines are what really matter.
Right. The underlying infrastructure outlives any single tenant deal.
So the physical asset itself acts as the ultimate bedrock collateral. And that leads perfectly into the regulatory side of this power equation, which I found to be the most deeply technical, yet secretly the most important part of the entire earnings call.
Oh, absolutely. The regulatory piece is huge.
They spent a lot of time talking about ERCOT, the Electric Reliability Council of Texas, which is the entity that manages the state's power grid. And there was a specific draft rule they mentioned called PGRR 145.
PGRR 145.
Yes, and we need to dissect this because if you pay a power bill in Texas, or if you hold stock in any tech company, this affects you.
If you want to understand the impenetrable moat that Galaxy is building around Helios, you absolutely must understand PGRR 145. In the modern world of hyperscale data centers, having billions of dollars in cash to build a facility is no longer enough.
Money isn't the bottleneck anymore.
No, you need physical permission to connect your massive facility to the power grid. And power grids globally are maxed out. They are strained to the breaking point.
Right. The Texas grid is notoriously fragile. We all remember the catastrophic winter storm Uri in 2021, where the grid nearly collapsed under the strain of freezing temperatures, leaving millions without power.
Yeah, exactly. It was a disaster.
And ERCOT operates an isolated grid. They don't cross state lines, which means they can't easily borrow power from neighboring states if demand spikes.
Exactly. And because of that fragility, ERCOT is implementing severe new rules for how they approve massive new loads of power, like an 830 megawatt data center.
So what are the new rules?
They are essentially creating batches to rigorously study the impact a new facility will have on the transmission lines before they allow it to plug in.
So it's like a regulatory waiting room. You have the money, you have the land,
Yeah.
but you have to sit in the ERCOT waiting room until their engineers run the math to see if the local grid will melt when you turn your servers on.
Yes, that is exactly it. And the critical issue is that sitting in that waiting room can take years.
And time kills infrastructure projects.
Exactly. But this is where PGRR 145 comes in. This draft rule establishes a specific baseload category for projects. If your project meets certain stringent criteria and qualifies for this category, you are placed in what they call batch zero.
Batch zero. That sounds exclusive.
It is. You bypass the new, lengthy study process. You avoid being constantly restudied and delayed. You become the foundational load that every other subsequent project has to wait behind.
And Galaxy's in batch zero.
According to their legal reading of the draft rule, yes. To legally qualify for batch zero, a facility needs two critical pieces of documentation: valid, fully completed interconnect studies and a fully signed, executed interconnection agreement with the local utility provider. Galaxy completed their exhaustive engineering studies back on January 15th, and their service agreement is already executed and legally binding.
They aren't just hoping for power. They hold the golden ticket.
Management explicitly called their 830 megawatts of approved power a one-of-one asset in the state of Texas.
A one-of-one asset.
Think about the leverage that gives them. When potential massive customers like Amazon, Google, or Microsoft are evaluating where to build their next multi-billion-dollar AI cluster, that regulatory certainty is invaluable.
Because they can't afford to wait years for approval.
Right. The fact that Galaxy is in batch zero and won't be subjected to years of bureaucratic risk study delays makes Helios incredibly attractive. Every major participant in the high-performance computing market has bottomless capital right now. What they desperately lack is secure future power capacity, and Galaxy has it contractually locked up.
And they are so confident in this position that they aren't even waiting for the final commercial lease to be signed for Phase 3 before they start spending massive amounts of money.
Oh, they are moving ahead quickly.
Management noted on the call that they have already placed heavy deposits and issued purchase orders for main power transformers and high-voltage circuit breakers.
That provides a vital insight into the current global supply chain. Lead times for acquiring main power transformers, the massive industrial machines that step down the extreme voltage from the transmission lines into usable power for the servers, those lead times can stretch to 3 or 4 years right now.
3 or 4 years just for a transformer.
Yes. Every utility and tech company in the world is fighting to buy transformers to power the AI boom. By securing that hardware supply early, even before the final tenant lease is inked, Galaxy is mechanically ensuring they can actually deliver the physical facility on time in 2027 or 2028. It is a massive, multi-year competitive advantage.
And just to cap off the sheer scale of the data center ambitions, they casually mention at the end of this section that they have an additional 1.8 gigawatts of power progressing through the ERCOT study process.
1.8 gigawatts.
And they're actively evaluating multi-campus, multi-tenant opportunities entirely outside of the Helios site. This is not a side project. This is a full-blown industrial power conglomerate incubating inside a digital asset company.
It is worth noting how the CEO structurally thinks about this. He literally stated on the call that he mentally separates the two businesses.
Really? How so?
He explicitly said he does not want to take hard-earned trading capital from the volatile crypto side and fund massive construction projects willy-nilly on the data center side. They evaluate the capital structure and financing needs independently.
That is disciplined.
It is. But the grand long-term strategic vision is that the massive predictable cash flows from these 15-year triple net data center leases will make the overall Galaxy enterprise wildly less cyclical. It will fundamentally divorce its baseline corporate valuation from the daily chaotic price swings of digital tokens.
If they pull it off, they've engineered the ultimate corporate hedge.
Exactly.
Now that covers the physical infrastructure. They are pouring the concrete and stringing the high voltage lines for the AI revolution. But the third major theme of this call requires us to pivot back to their roots. How are they approaching digital infrastructure?
Because they definitely haven't forgotten crypto.
Right. They have absolutely not abandoned their core crypto competency. They're merely mutating how they monetize it. We've seen how they handle physical bottlenecks, so now let's explore how they are systematically becoming the digital infrastructure provider for traditional Wall Street.
The CEO framed this beautifully. He called 2026 a transition year for the firm. He stated that they are moving aggressively away from operating a highly speculative business, what detractors historically called the crypto casino, to building a global technological utility.
A technological utility.
This represents a profound shift in corporate narrative and underlying strategy.
He noted that the massive legacy institutions, the global banks and asset managers managing trillions of dollars, they are all actively trying to figure out how to operate in a tokenized world.
They are very interested in it.
They're looking at tokenizing traditional equities, private equity funds, real estate mortgages, and fiat currencies. But tokenization is a buzzword that gets thrown around so much it loses its meaning. Let's explain the actual mechanics of why Wall Street is so obsessed with this.
To understand the obsession, you have to look at the massive inefficiencies in traditional back-office finance.
Okay, take us behind the curtain.
If you log into your brokerage account today and buy a share of a stock, or if a bank buys a mortgage-backed security, the trade appears instantly on your screen. But behind the scenes, there is an incredibly complex, slow, and expensive mechanical process required to actually settle that trade.
Right, the famous T+2 settlement cycle. Trade day plus 2 days.
Exactly. It involves a web of clearinghouses, like the DTCC, multiple disparate databases, days of waiting for funds to clear, and literal armies of compliance officers manually reconciling ledgers to ensure the buyer actually has the money and the seller actually has the asset.
It sounds incredibly archaic.
It is. This back office friction costs the financial industry tens of billions of dollars a year in operational overhead and tied up margin capital.
So how does tokenization fix that mechanical bottleneck?
Tokenization takes that traditional asset, a stock or a bond, and represents it as a secure, programmable digital token on a distributed blockchain ledger.
So it digitizes the actual ownership.
Yes. And by doing this, it allows the asset to be traded and settled instantly. 24 hours a day, 7 days a week, with perfect cryptographic transparency and zero reconciliation errors.
Because everyone is looking at the same ledger.
Exactly. The blockchain acts as a single source of truth. It mechanically eliminates the need for T+2 waiting periods and dramatically reduces the back office costs. Wall Street executives see this math. They know definitively that tokenized instant settlement is the inevitable future of capital markets.
But here's the massive catch. A 150-year-old traditional bank cannot just snap its fingers and start playing with blockchains overnight.
No, they really can't.
They don't have the underlying technology. Their legacy mainframe computers run on ancient programming languages like COBOL. More importantly, they do not have the battle-tested security protocols required to hold cryptographic private keys that secure billions of dollars in bearer assets.
And that technological vacuum is exactly where Galaxy steps in. For the past 8 years, Galaxy has been forced to build all of this complex, institutional-grade digital infrastructure simply to run their own internal trading and asset management businesses.
Because no one else had built it yet.
Right. They had to engineer the secure wallets, the custody solutions, the 24/7 trade settlement rails, and the multi-signature private key architecture.
And now they are productizing that internal architecture. They are taking their battle-tested tech stack and turning it into a B2B, business-to-business, white-labeled solution.
Which is so smart.
They are selling the underlying software infrastructure to the very legacy institutions that everyone thought would eventually crush them.
It is a brilliant strategic maneuver. Galaxy realized that their ultimate total addressable market, their TAM, is not just providing crypto trading apps to retail users.
But what is the real TAM?
The true massive TAM is the entire front, middle, and back office of global capital markets that desperately needs to be mechanically rewired for a digital native environment.
Wait, I am not buying that premise completely. I actually have to push back here.
Okay, let's hear it.
If tokenization is going to save Wall Street billions of dollars in back office costs and unlock massive new efficiencies, why wouldn't a financial behemoth like JP Morgan or Goldman Sachs just buy a pure play tech startup to do this? Or just hire 1,000 engineers and build it in-house?
That is the logical assumption, yes.
Why partner with a firm like Galaxy that has its roots in crypto trading, which brings a lot of regulatory baggage and volatility risk? That seems like a massive compliance headache for a stodgy traditional bank.
It seems counterintuitive at first glance, but the reality of institutional adoption comes down to the sheer mechanical complexity of cryptographic custody and speed to market. During the Q&A, Galaxy's president, Tony, addressed this exact dynamic.
What did he say?
He said that what people previously assumed would be their biggest looming threat, legacy banks building competing desks, has actually morphed into a situation where those theoretical competitors are limit up for partnering with Galaxy.
Limit up, meaning institutional demand for their tech is completely off the charts. But again, why rely on Galaxy specifically?
Two critical mechanical reasons. First is time to market. The tokenization wave is happening right now. A legacy bank simply cannot hire a team of highly specialized blockchain engineers, design a secure architecture from scratch, force it through their massive internal risk, legal, and compliance bureaucracies, and deploy it fast enough to capture the current market opportunity.
It would take too long.
Building it internally would take them half a decade of bureaucratic infighting.
And what is the second reason?
Trust and battle-tested security. In the world of tokenization, you are dealing with cryptographic private keys. The mechanics of a private key are unforgiving.
Right. There is no password reset.
Exactly. If a bank gets hacked or mismanages a key, there is no central authority to call. There is no password reset button. If you lose the key, the billions of dollars of bearer assets are gone forever.
Oof. Gone.
Galaxy has been operating in this hostile, hyper-adversarial environment for nearly a decade without suffering a catastrophic architectural breach. They intimately understand how these networks operate under severe stress.
So a risk-averse legacy bank looks at the equation and decides they would rather pay a recurring licensing fee for battle-tested, white-labeled software than take the catastrophic reputational and financial risk of building a faulty digital wallet themselves.
Precisely. Galaxy even acquired a highly specialized tech company called GK8 a while back, specifically to absorb their advanced cryptographic custody technology and bolster this exact B2B offering.
So Galaxy is essentially positioning themselves as the Stripe of tokenization.
Oh, that is a great analogy.
When you buy a pair of shoes on an e-commerce website, you don't know that Stripe is the invisible API mechanically processing your credit card behind the scenes. In the future, when a bank client logs into their normal banking app and buys a tokenized treasury bill, they will have no idea that the entire transaction is being routed, settled, and custodied on invisible software rails built and maintained by Galaxy.
That is an excellent way to think about it. And the profound beauty of this B2B model for Galaxy's future earnings is that it creates sticky, recurring enterprise software as a service revenue.
Which investors love.
They do. It is mechanically divorced from whether the spot price of a Solana token goes up 10% or down 10% on any given Tuesday. The revenue is driven purely by the pace of institutional utilization of the underlying infrastructure.
Speaking of Solana, The earnings call also touched on their consumer and retail-facing platform called Galaxy One. They mentioned they are quietly expanding its capabilities, recently launching Solana staking at 0% commission.
Yes, Galaxy One.
If they are pivoting so aggressively toward B2B enterprise software, what is the mechanical end goal with a retail platform like Galaxy One?
Galaxy One is their strategic play to unify the fractured user experience of modern finance. They are building toward a single cohesive platform where a user, and they noted this will soon expand to sophisticated business accounts as well, can hold fiat cash, traditional equities, and digital assets all in one unified interface.
That would be convenient.
And crucially, it allows for seamless cross-portfolio margin financing.
Explain the mechanics of cross-portfolio margin, because that sounds incredibly powerful.
It breaks down the artificial silos between traditional finance and decentralized finance. Imagine you hold $100,000 worth of traditional Apple stock in your Galaxy One account.
Okay, standard brokerage account stuff.
The platform's risk engine can instantly assess the value of that stock and allow you to use it as collateral to borrow fiat money to buy Bitcoin. Or conversely, you could use your Bitcoin holdings as collateral to borrow cash to buy traditional government bonds.
All in one place.
All seamlessly executed within a single wallet architecture without having to wire money between 5 different banks and crypto exchanges.
It creates immense capital efficiency for the user. They admitted it's still early days for the Galaxy One platform, but it clearly represents the consumer-facing manifestation of all that complex B2B infrastructure they are building for the institutions.
Absolutely. So we have analyzed the physical infrastructure of Helios and the digital infrastructure of their tokenization tech. But no corporation operates in a vacuum.
Right.
Galaxy can build all the brilliant infrastructure they want, but their operational reality is still heavily dictated by the macro winds of the global economy and the complex reality of regulatory chess in Washington, D.C.
Let's examine the external forces at play here. And to be absolutely clear for our listeners, we are going to look at the legislative environment strictly through the lens of how Galaxy's management models it on their balance sheet.
We aren't taking sides here.
Right. We are analyzing the mechanics of policy impact, not taking a political stance.
The macroeconomic and regulatory environment is perhaps the single most critical external dependency for the accelerated growth of their digital assets business. The CEO highlighted one specific piece of legislation: the Clarity Act.
The Clarity Act.
He noted that it is currently in a crucial 6-week window in Washington.
What does the Clarity Act actually do mechanically? Why is it so important to a company like Galaxy?
The Clarity Act functions essentially as a comprehensive infrastructure bill for digital assets in the United States. Currently, the regulatory landscape is governed by enforcement actions and decades-old securities laws that don't neatly apply to decentralized software networks.
It is a legal gray area.
Very gray. The Clarity Act aims to establish clear mechanical definitions of what constitutes a digital commodity versus a digital security and defines the jurisdictional boundaries of the SEC versus the CFTC.
So it provides a rulebook.
It provides the foundational legal certainty that massive, risk-averse institutions absolutely demand before they will fully deploy trillions of dollars into tokenization.
The CEO gave a very candid, pragmatic assessment of the political dynamics surrounding the bill. He noted that Republicans have generally campaigned on getting this clarity passed, and he believes that Democrats, in an election year, do not want to be put in a position where they have to actively campaign against technological innovation.
Right. It is a tricky political balance.
However, he did identify specific legislative bottlenecks. He specifically mentioned Senator Tom Tillis.
Yes. He noted that Senator Tillis is pushing very hard on the ethics and compliance piece of the legislation, partially due to friction with the administration.
Interesting.
The CEO referred to Tillis as a tough son of a gun, but ultimately expressed pragmatic optimism that they will navigate through that bottleneck. His underlying thesis is that the bill will eventually pass because it is politically expedient for both sides to resolve the ambiguity.
And it keeps the U.S. competitive.
Exactly. It is fundamentally vital for long-term American economic competitiveness.
If the Clarity Act passes, the CEO predicts it acts as a massive mechanical catalyst. It unlocks the institutional floodgates. But even beyond the gridlock of D.C., there is the broader, messier, global macroeconomic picture: inflation, central bank interest rates, and geopolitical conflict.
The CEO painted a complex, interconnected macro picture. He pointed to the ongoing conflict in the Middle East, specifically involving Iran, and projected that the resulting geopolitical friction and supply chain disruptions will likely drive some ugly inflation prints to come through the economic pipeline in the near term.
If inflation prints are ugly, meaning inflation remains stubbornly high, what is the mechanical reaction from the Federal Reserve?
Because of that sticky inflation, he does not expect the Federal Reserve to aggressively cut interest rates immediately. He models that the Fed will likely sit and watch the data for most of the year, keeping the cost of capital relatively high.
But wait, he did predict rate cuts by the end of the year. If he believes inflation will remain sticky due to geopolitical shocks, what is his mechanical thesis for the Fed eventually cutting rates?
This is where his macro thesis beautifully ties back into their physical data center business. He believes rate cuts will eventually materialize, not just because of a cooling labor market, but because of an incoming structural productivity miracle driven by artificial intelligence.
A productivity miracle. Let's dig into the mechanics of how AI actually causes disinflation across an entire economy.
He argues that the wild acceleration we are seeing in AI capabilities right now is mostly being executed on the computing infrastructure that already existed.
Oh, right. We are just getting started on the new builds.
Right. The massive new hyperscale campuses, like Phase 2 and 3 of Helios, won't even be powering AI training until next year or 2027. Therefore, the true, profound disinflationary impact of AI is only just beginning.
Disinflation meaning the rate of inflation slows down because things become cheaper to produce.
Yes. Think about the mechanical impact of AI on a corporate cost structure. Software engineers can code twice as fast using AI assistants. Massive corporate back offices can automate complex compliance and data entry tasks. Customer service can be handled by highly intelligent agents.
The efficiency gains are wild.
When AI dramatically increases human productivity across every sector, it structurally drives down the cost of producing goods and services. He believes this AI-driven productivity miracle will eventually exert such massive disinflationary pressure on the economy that it will give the Fed the mathematical cover they need to cut Helios rates.
And mechanically, lower interest rates mean capital gets cheaper. When capital is cheap, investors move out on the risk curve, seeking higher yields in growth assets like tech stocks and crypto, causing broad prices to rise.
Exactly.
Let's look at the actual price action they discussed on the call. Bitcoin dropped down to around $60,000 during Q1. The CEO stated he views that level as a tradable bottom for this specific phase of the market cycle.
Yes, he seemed confident about that floor.
By the time of the earnings call, it had bounced back to the $76,000 to $77,000 range. He models heavy technical resistance around $80,000 to $85,000.
Furthermore, he noted that the next major psychological threshold for the market is $100,000, though he was very careful to manage expectations.
He didn't promise it right away.
He stated it is not his internal prediction that Bitcoin breaks $100,000 this year unless they get that specific macro catalyst of an easing central bank cutting rates.
But this leads to a fascinating question about market mechanics and who is actually holding the assets. If we just lived through a massive 25% drop and the old school early adopter crypto whales are actively selling and taking profits, which the CEO confirms happening on chain, who is mechanically stepping in to buy the dip at these elevated $60,000 levels?
That is the big question.
Who provides the floor when the original holders cash out?
What the data shows is a profound structural demographic shift in the buyer base. It is no longer just early tech insiders or retail day traders. The massive buying pressure stepping in to absorb that sell-off is coming from entirely new mechanical channels.
Where is it coming from?
Retail investors are now pouring capital in through the newly approved spot Bitcoin ETFs, which trade like normal stocks. Institutional investors are buying massive amounts of MicroStrategy equity, which effectively functions as a publicly traded, leveraged Bitcoin proxy.
And the wealth managers. The CEO specifically name-dropped Morgan Stanley during the call.
That represents a seismic structural change in demand. Morgan Stanley is moving into the space aggressively, with their massive army of traditional financial advisors now actively pitching Bitcoin allocations as a standard, recommended part of a diversified portfolio for high-net-worth clients.
That is a huge shift from a few years ago.
When the largest wealth managers in the world start systematically allocating 1% or 2% of their clients' portfolios to an asset class, it mainstreams the asset and provides a massive persistent bid in the market. Furthermore, he noted that sovereign wealth funds, entire nation-states, are quietly accumulating positions. The underlying buyer profile has fundamentally matured.
There was also a geopolitical angle to the demand that I found absolutely fascinating. We spent all our time in the U.S. debating ETF flows, and regulatory clarity. But the CEO argued that the real fundamental use case for crypto has always been the rest of the world. He pointed to places like Paraguay, Bhutan, and Cambodia.
If you look at the global macroeconomic picture, in the U.S., we take our relatively stable currency and robust banking services for granted. But for 5.5 billion people globally, that reality simply does not exist.
Right, they don't have a Chase branch on every corner.
They lack access to basic checking accounts, or they live under regimes with crippling hyperinflationary monetary policy.
The CEO framed the exportation of stablecoins, which are digital tokens pegged one-to-one to the value of the US dollar, not just as a lucrative business opportunity for Galaxy, but mechanically as a powerful tool for United States geopolitical power projection.
It is a stunning framing. By providing the decentralized digital rails for billions of people around the world to hold and transact in digital US dollars, escaping their own collapsing local currencies, America effectively cements its economic hegemony over the global financial system.
It dollarizes the globe from the bottom up.
Crypto is often portrayed in the media as a rebellion against the US dollar. But the CEO is arguing that it is actually the ultimate digital Trojan horse to spread dollar dominance to every smartphone on the planet. And Galaxy is aggressively building the mechanical software pipes that will carry those digital dollars.
We are entering the final act of this analysis. We have dissected the digital plumbing of Wall Street, the massive AI power grids of Helios, and the shifting macro winds. Let's look at the immediate financial reality. Before we conclude, we have to look at how Galaxy managed its specific corporate risk during the Q1 storm and what the immediate financial trajectory looks like going into Q2.
Let's analyze their lending book. During Q1, their average loan book declined by approximately 20% quarter over quarter.
Now, if I'm looking at a traditional commercial bank and I see their core loan book shrink by 20% in just 90 days, my warning sirens go off.
Oh, absolutely.
A shrinking loan book usually means economic demand is evaporating or the bank is in distress. Is a shrinking loan book at Galaxy a massive red flag, or is this a deliberate mechanical feature of their risk management system?
In the specific context of a highly volatile digital asset firm, it is absolutely a feature, not a bug. Chris Brandler from Rosenblatt actually asked this exact probing question during the Q&A.
What did management say?
The response from management was a masterclass in risk management philosophy. The president stated point blank that the number one key performance indicator, the KPI, for the lending desk is not maximize yield, it is don't lose money.
Not grow the book at all costs to appease Wall Street analysts.
No. Don't lose shareholder money and don't lose client capital. You have to understand the mechanics of collateralized lending in crypto. A large percentage of their lending book is either denominated in or directly collateralized by highly volatile crypto assets.
Right.
When the underlying value of that collateral drops 25% in a single quarter, the mechanical risk engine should force the loan book to shrink.
Because if the book doesn't shrink during a crash, it means the firm is desperately extending riskier and riskier credit, lowering their collateral requirements, just to maintain a vanity metric of growth while the structural foundation is crumbling beneath them. That is exactly how firms blew up in the last crypto crash.
Exactly the opposite happened here. The 20% drop was mechanically driven by asset depreciation, clients naturally deleveraging to protect themselves from margin calls, and the natural roll-off of two large, low-risk loans that simply reached maturity.
So they didn't chase bad loans just to keep the numbers up.
Management didn't force new, risky loans out the door to replace them. They allowed the book to contract naturally and safely. The automated risk systems worked exactly as designed. They ruthlessly protected the downside.
And while the lending book contracted defensively, the asset management side of the house continued to actively attract new capital. They reached $8 billion in total assets under management, or AUM. And despite the terrible 25% drawdown in the broader market during Q1, they actually generated $69 million in positive net inflows.
That metric underscores the durability of their institutional platform. Institutional demand for access to the digital asset ecosystem remains structurally strong, and more importantly, those institutions trust Galaxy's specific mechanical ability to manage through extreme volatility.
They proved they can handle the bumps.
Right after the quarter ended, they proved this thesis by securing a massive new $75 million single client mandate, one of the largest separate accounts in their corporate history.
They also casually dropped a mention that they're launching a brand new fintech hedge fund.
Yes, a dedicated fund focused entirely on the convergence of traditional finance, blockchain infrastructure, and emerging tech. They are leaning heavily into their decade of experience as actual builders and operators to underwrite complex private investments that pure traditional finance venture funds simply lack the technical chops to properly evaluate.
Which brings us to the preliminary financial outlook for Q2. This is the ultimate payoff for all that disciplined defensive maneuvering in Q1. Because crypto prices started rebounding slightly in April, the mechanical leverage inherent in Galaxy's business model instantly appeared on the bottom line.
The preliminary Q2 numbers provided on the call represent the mic drop moment of the entire presentation. Remember, Q1 adjusted EBITDA was negative $188 million.
A huge hole.
But with just a slight improvement in digital asset prices and trading activity in the first few weeks of Q2, management revealed that their estimated adjusted EBITDA tracking through late April had already violently swung to a positive $90 million.
A positive $90 million swing in less than 30 days. It mechanically proves that when the market turns even slightly favorable, their operating engine is primed to capture massive exponential upside, specifically because they protected the corporate chassis so fiercely during the crash.
And this rapid financial swing brings up one final massive strategic point that was raised by an analyst from Jefferies at the very end of the call.
What was the point?
Given how radically different the hyper-stable, predictable 15-year cash-flowing data center business is from the highly volatile mark-to-market digital asset trading business, the analyst asked the obvious structural question. Does management have plans to split the company in two?
Oh, structurally spin off the physical Helios data centers into their own publicly traded infrastructure company. What did the CEO say to that?
The management team stated they have no immediate corporate update to announce, but they fully acknowledge the underlying financial logic of the question. They admitted that the capital structure, the debt requirements, the earnings potential, and the multiple that Wall Street assigns to the two businesses are entirely different.
It makes a lot of sense.
Right now, they are laser-focused on executing the build-out of both sides simultaneously. But the CEO heavily hinted that as their current convertible debt matures and rolls off at the end of the year, and as Phase 1 of Helios becomes fully cash-flowing while Phase 2 comes online, a formal corporate split might become a very real boardroom debate going into 2027.
That is massive. Unlocking the immense valuation of a pure-play, gigawatt-scale AI infrastructure asset from underneath the discounted valuation of a volatile crypto trading firm. If you are a shareholder looking at the mechanics of value creation, that potential spinoff could be a monumental catalyst down the line.
It definitely could be.
We have covered an immense amount of complex mechanical and financial ground today. Let's bring all these disparate threads together for you, the listener. If you only read the superficial headlines of the Q1 2026 earnings report, you saw a company that ostensibly lost $200 million simply because the price of Bitcoin went down. But having taken this deep dive into the actual source material and the underlying mechanics of their operations, you now understand the real story.
The real story is absolutely not about a company merely surviving another cyclical crypto crash. It is the story of a corporation undergoing a profound structural mutation.
They are evolving.
They are utilizing the massive balance sheet and the hyper-specialized trading expertise of a digital asset firm to fund and physically construct the hard gigawatt-scale infrastructure of the AI revolution, the Helios data centers in Texas. And simultaneously, they're productizing their internal tech stack to build the invisible digital infrastructure that will mechanically allow legacy Wall Street to tokenize the global financial system.
They're playing a completely different, multi-decade infrastructural game than the retail day traders obsessing over token prices. And that leaves us with a final provocative thought for you to mull over as you analyze your own portfolio or your company's strategy. For years, the loudest, most exhausting debates in the financial media have been about which specific crypto token is going to definitively win the future of finance. Will it be Bitcoin, Ethereum, Solana?
The tribalism is intense.
But based on Galaxy Digital's aggressive billion-dollar mechanical pivot into physical power grids and white-labeled B2B back-office technology, what if the ultimate winner of the digital asset revolution isn't a token at all?
What if the real generational wealth of the next decade isn't captured by the funds endlessly speculating on the direction of digital assets, but by the invisible industrial infrastructure companies quietly pouring the concrete, securing the copper wires, and building the impenetrable private key architecture that actually allows the rest of the world to play the game?
What if the most valuable player in the crypto casino turns out to be the company building the power plant that keeps the lights on? We will leave you to think about that. Thank you for joining us on this deep dive. Keep looking past the headlines, keep questioning the underlying mechanics of the markets, and we'll see you next time.